Did you know that Warren Buffett pays a lower tax rate than his secretary? While that might sound outrageous, it's completely legal and reveals something fascinating about how the world's most successful investors think about taxes. Today, we're diving deep into the strategic minds of billionaire investors to uncover the perfectly legal tax avoidance techniques that have helped them build and preserve enormous wealth. But before we jump in, let me be crystal clear about something. We're talking about tax avoidance, not tax evasion. One is legal and smart, the other lands you in prison. The strategies we'll explore today are the same ones used by Harvard endowments, pension funds, and yes, your favorite billionaire investors. These aren't shady offshore schemes, they're sophisticated financial strategies that anyone can learn from. Think about this for a moment. The difference between paying 30% in taxes versus 15% on a $1 million investment gain isn't just about the money, it's about compound growth over decades. That extra $150,000, when reinvested intelligently, becomes millions over time. This is why understanding tax strategy isn't just about saving money today, it's about building generational wealth. The first principle that separates amateur investors from professionals is understanding the difference between ordinary income and capital gains. Most people work for wages, which get hammered by the highest tax rates. But wealthy investors structure their compensation and investments to take advantage of preferential capital gains treatment. They're not earning paychecks, they're growing assets. Consider how Jeff Bezos approaches this. His Amazon salary was famously just $80,000 for years. Meanwhile, his wealth grew by billions through stock appreciation, which isn't taxed until sold. Even when he does sell shares, those gains are taxed at capital gains rates, not ordinary income rates. This isn't an accident or lucky timing, it's strategic thinking about how wealth actually grows and how the tax code rewards different types of income. The second strategy involves something called tax loss harvesting, and it's absolutely brilliant in its simplicity. Smart investors deliberately realize losses to offset gains, reducing their overall tax burden. But here's where it gets sophisticated. They don't just randomly sell losing investments. They carefully orchestrate their portfolio to maximize tax efficiency while maintaining their desired asset allocation. Let's say you bought two similar tech stocks this year. One gained $20,000, the other lost $15,000. An amateur investor might hold both, hoping the loser recovers. A strategic investor might sell both, realizing the $20,000 gain and $15,000 loss, netting only $5,000 in taxable gains. Then they immediately reinvest in similar but not identical assets to maintain market exposure. This strategy, when executed properly, can save thousands annually while keeping investment goals on track. The third technique involves maximizing tax-advantaged accounts, but not in the way most people think. Everyone knows about traditional retirement accounts, but wealthy investors use strategies like backdoor Roth conversions and mega backdoor Roth contributions that most financial advisors never mention. These allow high earners to funnel hundreds of thousands of dollars into tax-free growth accounts annually. Here's where it gets really interesting. Some investors use a strategy called tax location optimization. They deliberately place their highest growth investments in Roth accounts where gains will never be taxed, while keeping income-producing assets in traditional accounts where they can deduct contributions today. Over decades, this strategic placement can save hundreds of thousands in taxes. The fourth principle involves timing and patience. Warren Buffett has held some investments for over 50 years, never paying capital gains taxes on the appreciation. This isn't just about believing in great companies, though that matters too. It's about understanding that every time you sell an appreciated asset, you're giving the government a cut of your gains. The longer you can defer those taxes, the more your money compounds without government interference. But here's a more advanced timing strategy. Smart investors often accelerate deductions into high-income years while deferring gains until lower-income years. If you're having an unusually profitable year, it might make sense to realize some losses or make charitable contributions to reduce your current tax burden. Conversely, if you're between jobs or having a down year, it might be the perfect time to realize some long-term gains at lower rates. The fifth strategy involves geographic arbitrage and understanding different tax jurisdictions. This doesn't mean becoming a tax exile, but it does mean being strategic about where you live and where you structure certain investments. Some states have no income tax, others have no inheritance tax. Some countries have tax treaties that create opportunities for international investors. Consider how many hedge fund managers structure their carried interest through states with favorable tax treatment, or how real estate investors use opportunity zones to defer and potentially eliminate capital gains taxes. These aren't loopholes, they're incentives built into the tax code to encourage certain types of investment and economic activity. The sixth technique involves charitable giving strategies that benefit both society and your tax situation. Wealthy investors don't just write checks to charities. They use donor-advised funds, charitable remainder trusts, and direct donations of appreciated securities to maximize their tax benefits while supporting causes they believe in. Here's a powerful example. Instead of selling stock to get cash for a charitable donation, smart investors donate the stock directly. They get a deduction for the full market value while avoiding capital gains taxes on the appreciation. The charity receives more money because they're not paying the investor's tax bill, and the investor saves more on taxes than if they'd donated cash. The seventh principle involves understanding business structure and how different entity types are taxed. Many wealthy individuals aren't just investors, they're business owners who can deduct business expenses, take advantage of Section 199A deductions, and structure their affairs to minimize overall tax burden. Real estate investors particularly excel at this. They use depreciation to create paper losses that offset other income, even while their properties appreciate in value. When they eventually sell, they use Section 1031 exchanges to defer gains indefinitely by rolling proceeds into new properties. But perhaps the most important lesson from studying how wealthy investors approach taxes is their long-term perspective. They're not trying to avoid paying taxes this year. They're trying to optimize their lifetime tax burden. Sometimes this means paying more taxes now to save more later, like with Roth conversions. Other times it means deferring taxes as long as possible to maximize compound growth. The key insight is that taxes are just one variable in a complex optimization problem. The goal isn't to minimize taxes at any cost, it's to maximize after-tax wealth while managing risk and maintaining liquidity when needed. This requires sophisticated thinking about timing, asset allocation, and strategic planning that goes far beyond simple tax tricks. What makes these strategies so powerful isn't just the immediate tax savings, but how they compound over time. When you consistently keep more of your investment gains through strategic tax planning, those extra dollars generate their own returns year after year. Over decades, the difference between tax-aware and tax-ignorant investing can literally be millions of dollars. The beautiful thing about learning from the world's savviest investors is that many of their strategies can be scaled down and applied by anyone serious about building wealth. You don't need billions to benefit from understanding tax loss harvesting, maximizing retirement accounts, or timing your investment decisions strategically. The next time someone tells you that taxes are just the cost of living in a civilized society, remember that how much you pay in taxes is often a choice. The wealthy understand this, which is why they invest heavily in tax planning and strategic thinking about how the system actually works.